What's going on, everyone? Welcome back. My name is Lucas Miller, host of the Fear-Free Passive Investing podcast, host of this YouTube channel, and I thank you for stopping by. If you're new here, welcome. We help busy professionals navigate the world of passive commercial real estate investing. We give them clarity on what they should and shouldn't be focusing on. So if that sounds of interest to you, subscribe to this channel, hit that notification bell, and let's get going. All right, so let's jump right into the video. Today we're going to be talking about a question I get a lot, and that is, what is the difference between a Reit, a syndication, and crowdfunding? So to start, I just want to clarify that this isn't going to be an exhaustive list. We're not going to go through every little facet of each individual investment type. We're just going to give a brief overview of A, what it is, and B, the differences, the pros, the cons, the benefits of each individual type. And then if you have specific questions, make sure to leave them down in the comment section and I'll answer them there. But if we had to go through everyone's individual circumstance, it would take forever. So let's start with just a basic definition of each one. So let's start with crowdfunding. Most people have heard of this. They understand what it is. They've heard of Kickstarter. They've heard of GoFundMe. They've heard of other things where you can basically put in a little bit of money and pool it together with a bunch of other people and help a cause. Well, it's the same idea, but in real estate. Before we get into the definition of crowdfunding and syndication, I want to give a little bit of background information on those two particularly, because most people have noticed that they've had this meteoric rise lately over the last decade or so where they've become incredibly popular by folks. So to start, the reason for that is in 2012, President Obama signed in the American Jobs Act, which introduced the country to private equity offerings that they hadn't necessarily had access to before. Syndications have been around for decades and decades, but they've always been very hard to get to, essentially for non-accredited investors, for folks that aren't really on Wall Street or aren't registered with the SEC. So that really opened up the floodgates of who could have access to these private equity offerings. Since then, crowdfunding has, gone crazy, so have syndications, and it's opened up this wave of new investment firms and new investment options. I was doing a little bit of research for this video, and over 100 different crowdfunding platforms have started and gone out of business since then. That's crazy. So, of course, there's been some that have stood the test of time, like Realty Shares or CrowdStreet, a couple others that have been around for a little while and are a little more legitimate now, but 100 different have started and stopped since then, which is crazy to me. And the basic idea behind crowdfunding is that you can put in a little bit of money and pool it with other investors, putting in the same a little bit amount of money, and you have this big pool of a bunch of people invested into one particular project, whether it's a fix and flip, whether it's a rental portfolio, or commercial real estate like we're going to talk about today. But basically, you put in a little bit of money along with a lot of other people, and you're spread. The idea behind it is that you are diversified amongst a bunch of other things. So let's talk about crowdfunding, the entry price, the benefits, and all of that. So entry price on syndications, it can vary, right? It's a wide variety, but somewhere around $1,000 to $5,000 to $10,000, depending on the type of project, the entry level, the platform, and your level of involvement. Now, that's a pretty low barrier to entry. The return profile is probably medium, I would say. It's not as good as you could get with a private offering, but it's much better than you could do in the stock market probably. So let's talk about some of the risks of investing in these crowdfunding platforms. So to start, you don't know the sponsor. You can't call them, you can't interview them, you can't really do a lot of due diligence from an investor standpoint on the actual operator. That's a huge risk for a lot of these things because that's one of the main reasons these deals fail. So also, they have a low barrier to entry. Now, some might see that as a benefit, but I have a theory that it's actually a disadvantage because the lower barrier to entry something is, the lower your return metrics are going to be. Think about it. It's supply and demand. If everyone has the ability to go into a bank and buy a CD and, basically just walk into a bank, put down $100 and buy one, that's not really that high of a barrier to entry, so your returns aren't really that much in demand. Whereas you look at something like a real estate flip, like you're flipping a house, you got to have systems in place, you got to have a deal, you got to have contractors, you got to have all these things that put you at a really high barrier to entry, that's probably one of the best ways to make money quickly. But it's hard, right? It's hard to do. So think about crowdfunding as sort of a medium barrier to entry. Pretty much anybody can go on, make an account, put in some money. A lot of people can save 5 to 10 grand and invest in a deal. So your returns are probably going to be somewhere around the middle, right? Supply and demand says that it's probably not going to be great, but it's probably not going to be worse. So another risk is that it is very expensive to the sponsor, to me in general. And if I have a deal that's trading and I got to be competitive and put in a really good offer price, but that offer price is going to yield my investors 10% cash on cash return if I can go and raise the money myself. Great. If I can't raise that money for myself, I have to pay a middleman like a crowdfunding platform to go and raise that money for me. So my 10% deal might be down to 9% or 8.5% or lower. So it's expensive to me, right? And that money's got to come from somewhere. And then one big last risk is the platform. You are investing in another business. Like I was saying earlier, 100 of these companies have come and gone since then. You're really investing in 2 different businesses. One is the platform, the other is the actual deal, the business plan. So when you think like, how can I minimize my downside risk? You're investing in 2 basically startup businesses parallel to each other. But let's talk about some benefits of crowdfunding. The benefit obviously is like it's a low barrier to entry, right? You only have to have 5 to 10 grand to invest in a deal. You can take what would be, a $50,000 chunk of money and put it into a bunch of deals and diversify yourself over that. So that's a huge benefit. You're able to mix diversity in asset classes. So you can put one in multifamily, one in a flip, one in an office building, and just kind of diversify yourself over a couple different asset classes. And it's more like stock trading almost than investing in real estate. You kind of pick and choose. It's all done online. You can do it from the comfort of your home, and it's easy to do. So in a nutshell, that is crowdfunding for me. Now let's talk about syndications, which is very similar to crowdfunding, and it's a little different, but to me it's much more preferred. So for syndications, what are they? Syndications are essentially a way for investors to pool money together to buy a project that is much bigger than what they could do on their own. It is passive, just like crowdfunding, but you are talking about a much larger scale. So if crowdfunding is a small amount of money over a large period of investors or a large swath of investors, think of syndications as a higher price point with less investors but a more intimate setting. And what I mean by that is most of these syndications that are done nowadays are done through an SEC exemption from filing an IPO called Reg D 506B or C. And we're not going to get into what the difference is between Regulation 5 or Rule 506C and B is today, but just know that in most cases you have to have a pre-existing relationship with the sponsor or be accredited or have some sort of a tie to the investor or to the active investor, the general partner. And so what you get is you don't have a ton of advertising. You can do some advertising in some circumstances, but most of the time it's just like, hey, I know my cousin, he's got some money, he's going to invest it with me because we have a pre-existing relationship. He might or might not be accredited, so it doesn't really matter if you're doing a 506B. And you just have a direct access, direct ties to the sponsor, which is really cool for some people. For some people, giving up control of that kind of money, usually somewhere around $50,000 to $75,000, in my case anyway. You really want to have that sponsor's phone number. You want to know what their email address is. You want to have direct access to them if you have questions. And that's really a huge benefit over crowdfunding is the direct access to the CEO of the business which you're investing in. All right, so let's talk about the entry price. Very high, right? That's what we were just talking about. $50,000, $75,000 in my case, sometimes as low as 25, sometimes as high as 100 grand. That's much more than what you're gonna get in our other 2 options, the Reit and the crowdfunding. But again, like I was saying, the return profile is going to be higher too. If you have a higher barrier to entry, your returns are going to be higher. Okay, so let's talk about some risks now because they are not without risks. The biggest risk of all, of course, is losing all that money, right? That's possible in a REIT, that's possible in a crowdfunding and in a syndication. However, with a syndication, you're losing $50,000 to $75,000 as opposed to $5,000 or $10,000 like in crowdfunding. Some people can't stomach that. I'm convinced that's the only reason why crowdfunding platforms are as successful as they are, because it's more like a mutual fund where you can, invest that $5,000 bonus you got or whatever, so you don't have to save up that money and put it into all your eggs in one basket, essentially. You're not diversified in syndications unless you have multiple deals in multiple different asset classes or regions or different sponsors, which makes finding a credible operator all that much more important. And it's easier to do with syndications, of course, because you can, like we were saying, have direct access to them. You can interview them. You can go have coffee with them. So it's a little easier to vet the sponsor, but it is critical. All right, let's talk about the benefits, because I am a huge fan of syndications. Clearly, I'm dedicating an entire channel to this. I have a podcast directed to this. So clearly the benefits are huge for me. But the biggest benefit is the great returns and the great tax advantages. In syndications, you get the pass-through tax benefits like depreciation, distributions, cost segregation, things like that, that you can use to offset your ordinary income. And your disbursements are taxed as, disbursements, not active income, not ordinary income. And so that's the way you're able to show on your K1 a loss on paper, right, through depreciation and cost segregation, while still getting cash flow distributions. So it's really a cool thing, and if you haven't looked into it, we're going to do a video on cost segregation soon. So make sure you pay attention to that. You hit that notification bell so you're alerted when that video does come out. But cost segregation is essentially depreciating the building on a rapid scale, so you can take that loss and carry it forward against any sort of ordinary income. Okay, now let's talk about a REIT, or a real estate investment trust. It's an acronym. Publicly traded REITs are available on the stock market, or the stock exchanges, and as such, you're buying one share of a company, and it's an extremely low threshold, right? Just like buying a stock. Sometimes you can buy penny stocks. You can't, I don't really know if there's penny REITs shares, but I would doubt it. But REIT shares are backed by a portfolio of just a bunch of properties, right? Sometimes hundreds of properties, usually in one asset class. So you can have a multifamily REIT, you can have a office REIT, you can have a hospital administrator building REIT, just things like that that have a huge portfolio and diversification among the portfolio. With a REIT, you have no control over the assets owned, right? That makes sense because they're buying them potentially before you're buying shares. And REIT shares trade with the ups and downs of the market too. Publicly traded REITs are easy to buy and sell. That's one of the huge benefits of them, is they're very liquid. Now there are non-publicly traded REITs, and they are a little harder to buy and sell. They're not publicly traded, so they're a little more illiquid. You must hold them for at least a year before you can sell them, which is the same in a syndication. You can't buy and sell shares very quickly. You can transfer shares, assuming you're transferring from, like, if I were to buy a share in my name, Lucas Miller, and transfer it to my Lucas Miller LLC, you can do that within a year, usually in most cases. You just have to prove it's the same person. So same thing with a REIT, and I would imagine same thing with a crowdfunding platform too. They don't want people buying and flipping these things. Okay, so the entry price for REITs varies, but it's much smaller than both the other options, right? It's like buying a stock. But again, going back to my same theory, the return profile is a little lower too, right? And it's leveraged in most cases. Okay, so some of the cons for REITs is, again, you don't know the sponsor. You can do some public due diligence, you can do some fact-finding due diligence on, the company, their track record, things like that, but you don't know the actual person that is taking your money. And they have a very low barrier to entry, so the returns are going to be a little lower. You still are exposed to that management risk, right? You're still investing in a business. You're still investing in real estate right alongside it, so there's no control of stuff like that, but you also don't have the added benefit of control over what property you invest in. Now, if I, as an investor, have made the decision, hey, I don't want to invest in something with a flat roof. In a syndication and in a crowdfunding platform, you can choose to say, oh, I'm going to pass on that because it's got a flat roof. In a REIT, you don't have that option, so you're exposed to that risk. Also, with a REIT, you don't have any ownership tax benefits. That's a huge con. So dividends are taxed as ordinary income, not disbursements. So that really sucks if you're trying to reduce your taxable liability. But the benefits are clearly that they're very easy to buy and sell, and it's passive, just like syndications. So it's a nice little diversification in if you want to diversify into big real estate companies with a proven track record that you can look at and really nitpick and make sure that it's the right fit for you. All right, hope you enjoyed the video. Thank you so much again. Again, if you're new here, please subscribe and click that notification bell. It's really gonna help us take off and make the YouTube channel a little more popular so we can reach more people. Again, if you have questions, please leave them down in the comments. I will get back to you as soon as I can. And also, if you have an idea for a video that you want to see, go ahead and leave that down in the comments too. I'm still looking for new content, what people want to hear, what people don't want to hear. So that would help me out a ton. Check out Fear Free Passive Investing Podcast. Check out this YouTube channel. I got a bunch of other videos on there. So stick around, click that notification bell, and I'll talk to you soon. Thank you.